Good afternoon. Welcome to Midcap Radar. I'm Sonal Bhutra and with me is Reema Tendulkar. A lot of stocks in focus. The markets, they have come off from the highs of the day. We have the Nifty sitting with cuts of 43 points at the day's low. But the midcap side of things, they are looking good. As we speak, that particular index is up 96 points. The Bank Nifty too is quite resilient. So that one is up 0.3%. But it has come off from the highs of the day and we have earnings that are coming in as well. But let's do one thing. Let's talk about the first corporate that is in focus today. It is Marico. The FMCG major reported largely flat margin and a weaker growth outlook. The stock is down over 7% in trade today. Mangnam Malu caught up with Saugata Gupta, who is the MD and CEO of the company, and began by asking about the quarter gone by and how the company sees demand pan out over the coming quarters. Listen in.
I think we were more or less in line with street estimates. Having said that, two things happened. One, contrary to expectations, the commodity market, at least as far as Parachute is concerned, continues to fall in a gradual manner, which means that we were always playing catch up with pricing. As a result, our prices have not been able to stabilize in the market. And as you know, that Parachute is a mass distributed brand, therefore it takes 6 to 8 weeks for the prices to stabilize and the price discovery to happen with the consumers. And therefore, we have not been able to get the volumes back, which I believe now is going to happen come around November, December, certainly around December, because now we see the stability happening. In addition to that, I think there are two more issues. We had a one-time cost which we had in Saffola, which was required to get the volumes back in place, and we are now getting the volumes back in place after a disappointing first quarter to get the prices. And as you know, we covered the ground stock and we covered the high cost stock in terms of the pricing, which was a one-time loss in terms of the profitability. In addition, obviously, in spite of the resilient performance in some of the international markets, there are some forex issues. And plus the EBITDA to PAT, there is an increase in effective tax rate. So given all these, I think there was a slight, I would say that I don't think it is in line with the market. It is in line with how the category is playing. And the fact is that our diversification strategy is very much in place. Food continues to grow aggressively. The international business is very robust, and as well as the entire digital business. So I think we should be back. We have already had a swing in volume growth. We are in positive territory, and we at least expect to give a mid-single-digit growth in the Q3 and moving forward.
Right, mid-single-digit growth in the second half is what you've guided for already. Will that be equally distributed across Parachute, value-added, Saffola, or will some parts grow faster? I mean, can you give us a sense of how this will be spread across all your verticals here?
So I think it depends on the extent of the rural recovery. We are seeing, at least as far as urban is concerned, the discretionary part of the portfolio, the foods, and if you look at food is performing much better than some of the HPC categories. So it depends on some of the market, but we definitely believe that having stabilized Saffola, will be able to stabilize Parachute volumes in this quarter.
Right, and as far as margins are concerned, you've guided for 18 to 19% for the entire year. How stable or how confident are you of this? Because raw material environment still continues to be volatile.
So if we look at a YOY perspective, I think copra has settled down to a level which is far lower than last year. I think some of the increase that has happened in petro-based products, as I believe is priced in. And also we are seeing a little bit of a marginal decline in other vegetable oils. So having said that, and as you know, last year by Q4, the inflationary conditions are already set in. So if you look at it, I think sequentially we continue to see improvement, and we are extremely confident of delivering that 18 to 19% operating margin for the full year.
And what would the price growth according to you be in the second half of this year? I mean, volume led would be around mid-single digits. Trying to understand how much of that would be price?
So there will be marginal deflation that will continue. That will, I think, anniversarize sometime in Q1 of next year. And however, as far as international business is concerned, we continue to expect maintain the growth momentum and deliver double-digit growth.
Quickly on your growth businesses, food now, you have this aspirational target of 850 to 1,000 crores by the end of next year. Just wanted to understand, what is your current first half absolute revenue in the food business. And how much of this 850 to 1000 will come from the current categories that you're already in, and how much of that will be new categories? Because competition in this space is extremely rife. I mean, I was just speaking to Tata Consumer. Everyone's eyeing this space.
So I think, first of all, the food headroom for growth is very high. If you look at the packaged food penetration in India, it's extremely low. And therefore, I think food as a category has high potential. In addition to that, I think we are driving this through Saffola. I believe it's a very strong under-leveraged brand, and therefore the entire strategy is based on the total addressable market expansion through Saffola. If you look at the run rate currently in foods, we are clocking around 650, and we are extremely confident that we should be able to hit the 850 to 1000 crores. We have launched, if you look at our categories, I think, as you know, oats and masala oats is now attained critical mass. It's doing very well. We believe honey and the soya nuggets and the soya journey, we want to replicate just the way we did masala oats through value addition, is expected to 100 crores run rate soon, both the categories. And we expect to be at least in 2 more categories by the end of this financial year. So there is a significant innovation plan in foods. We are also open to looking at inorganic, and we are extremely confident of hitting the 850 to 1000 crore mark.
International as a proportion of your sales has increased, and that's largely because of your outperformance in Bangladesh, etc. Going forward, where do you think this will stabilize as a percentage of your overall sales?
So international has been a success story. I think if you look at both profitable growth, and I think the biggest thing about our international business is 7 consecutive quarters of double-digit growth is very consistent. It's not unpredictable. And what we have been able to do is to replicate the Bangladesh success into Vietnam, and now we are doing it in Middle East and North Africa. Our innovation success rate in terms of diversification of the portfolio in Bangladesh, in Vietnam, and now in Middle East has been pretty successful. So I think we are pretty confident of being able to deliver this, chugging along this double-digit constant currency growth. Yes, there are short-term headwinds in certain markets in terms of currency depreciation, some inflation, but given our current robust execution excellence and the portfolio, and I think we have done significant changes and have best-in-class leadership, we are extremely confident of delivering this predictable, profitable growth.
What is digital and premium current run rate at?
So digital is expected, we're currently at 250, but premium is hitting 300 plus. So I think that is exactly what we have done. If you look at a scenario post 2020 and now, we now have around a significant portion of anything between 1300 to 1500 crores of actually new business. And that has been the single biggest success of Marico in terms of a significant diversification of our portfolio.
That is the big, stock which is under pressure. Marico today down 7%. We'll get into a break. On the other side, we'll invite Himanshu Baid, the MD of Poly Medicure, on the show now. Welcome back to Midcap Radar. Let's invite the management of Poly Medicure on our show. It's a medical devices maker, and the company has reported a nearly 30% jump in profits, and margins too have improved. Note that 60% of Poly Medicure's revenues comes in from exports, of which 70% is dollar denominated. To discuss the earnings and the impact of a strong dollar, the status of the PLI scheme, and much more, we are joined by Himanshu Baid, the MD of the company. Mr. Baid, afternoon, and thanks so much for joining in. Revenue growth of 23% this time. Could you break that up? What was the revenue growth in exports, the revenue growth in domestic, and any signs of slowing down in terms of exports, and what was the impact of the currency?
So currently, the domestic business grew around 27% quarter on quarter, and export business grew around 22%. And there was a very marginal impact on the currency, maybe less than 1% on the revenue, because we have also euro and GBP denominated exports. So overall, it kind of balanced out. So I think in terms of currency, hasn't played any major role in increase in revenue, almost negligible.
Not on the revenues, but Mr. Baid, I wanted to understand the margin expansion that you saw this time around. And you had earlier indicated that the second half will see better margins on the back of softening of raw material prices as well. What is the guidance here in terms of margins? 23.5%, is that something that you will maintain, or you'll do better than that?
I think, the raw material prices have started softening in August. and also the freight rates have started softening sometime in August. So I think the final impact we'll see in Q3 and Q4. And I said earlier, I think we are going to maybe see an improvement around 200 to 250 pips in coming quarters if raw material prices stay where they are and the freight rates stay where they are today.
Oh.
Any number on the margin front?
Yeah, I'm talking about the margin front, basically on the margin side. From 23.5%, margin, EBITDA margin was close to 23, 24%. So we're going to see that 200 pips improvement if things stay where they are today.
In 2 quarters, by Q4 FY23 end, right? Improvement of 200.
Exactly. So in the next half of the year, let's say in the second half of the year.
Okay. Any signs of slowdown in the export market?
No, I think we have got a good run right now. We have, if you look at the first 6 months, we have seen around a 30% growth in exports. So I think that continues, and I think we have a very steady order book. So we see no signs of slowing down right now in exports, at least on the medical device sector.
No signs of slowdown, that is a good thing. I wanted to understand what is the quarterly run rate that you're seeing in the US, because that's a big market for you, so to say. You are expecting a lot of approvals from the US FDA by the end of this year as well. What will that take your current run rate to? First, just quantify the current run rate and how much can it go upwards by?
See, currently, US, we are doing close to $100 million. It's not a big revenue from US right now. But what we are expecting is some new filings, which we have done, and some new filings will be done in November. And hopefully in 60 to 90 days from that filing, this is a final filing for a couple of product approvals. So if that goes through, I think in Q4, we should get all our approvals and we should start our revenue stream from the US. And as I said earlier, in 3 to 4 years, we're looking at around close to $15 to $20 million from revenue from US markets. And we are seeing some good traction. A lot of new inquiries are coming from the US because of, I think, current global issues companies are facing in China. So I think it could be a good going 3-4 years could be a good traction from the US.
Okay, so the annual US revenues could rise to $15 to $20 million in the next 3 to 4 years from the current run rate of $4 million, right?
A million. Currently it's $1 million on an annual basis.
Okay, I thought $1 million on a quarterly basis.
No, it's $1 million on an annual basis.
Okay, could you give us some more clarity on the new filings which are expected in November itself, and what would the number look like in Q4? I mean, is this uptick? Yeah, go ahead.
I think in Q4 we'll not say too much of an uptake. I think it's going to be a slow build-up. But as the markets, I think once the products are approved, we've already done through all the clinical trials. And these filings are based on the earlier filings because the additional couple of testings have to be done, which have been now under progress. And hopefully in the next couple of weeks, we're going to file those with the US FDA. So I think, and that's how this is going to move forward. I think it's going to take a while before we step up, but it's a 3-4 year cycle where we see revenues, reaching that $15-20 million milestone.
Okay, so that is on the US markets. What about the PLI scheme investments? You had been talking about a big opportunity here. Investment commitment of 70 crore rupees in the next 6 years, that is from FY22 to FY28. How much of an investment have you made till now, and what has the progress been here?
See, I think in the PLI, we had 2 particular products. One was the renal sector. So in the renal, we have to make an investment of 70 crores. So we are in line with that over 5 years. And this is mainly in new plant and machinery, which we're already doing, expanding capacity. And hopefully by next year, we'll double our capacity for our renal products. So that is going on as per plan. On the in vitro diagnostics, also we are making some new investments, adding some new capacities in new product areas. So, and there we have to make an investment of 50 crores as per the PLI scheme. So that is also, going on as per schedule. But these investments are spread over 4 or 5 years. So these are very small compared to what we are doing overall investment. Like for example, this year, our total capex will be in the tune of 175 crores to 200 crores. So already a lot of expansion is happening, in new products and a new enhancement of capacities, even for existing products.
Okay.
But even for in vitro diagnostics, are you on track to achieve the required revenue, which will help you get the incentive from the government?
Yeah. We are in
both.
track. So in vitro, it's an incremental revenue of 1 crore.
Okay.
And every incremental revenue, you get 5% as per the new PLI scheme. But on on renal products, there is a certain threshold we have to meet every year to get the incentives.
Okay. Mr. Baid, I wanted to speak to you about your dialysis machine segment as well. Till September, you had sold 140. The target is 500. Yeah. Are you on track to achieve that, or will you do better than that? Because how has October and November looked so far? November, at least, of course, 6 days. But how is October for this particular segment?
See, dialysis machines is an ongoing business. So, see, this year we have totally we have installed 140 machines till now. But our target is that by end of the year we should be able to install around 200 plus machines. And next year our target is to sell around 500 machines.
Okay, so till September you've done 140. So you expect only more 60 to go in the next 6 months. Is that what you're saying?
Yeah, because see, we are building up the whole project. See, right now it's a slow start. It's a new product, and it needs a lot of testing right now. So we will sell around 60 to 70 machines in this current H2 period. But then going forward, we'll scale up because we are setting up the unit to scale up production for dialysis machines now.
All right, Mr. Baid, it was a pleasure speaking with you. Thank you so much for joining us and giving us all those details. So that's the word coming in from Poly Medicure. Strong set of numbers, and they expect to contain this momentum as well. And margins will improve from here on. And the top line growth has been strong as well. Exports have seen no slowdown, so to say. With that, we'll do one thing. We'll slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned.
Okay, the stock which is on our radar right now is Alkyl Amines on the back of its earnings. Sonal, how did it look?
Well, it's weak, Reema, and surprisingly, we saw weaker numbers. This is when Balaji Amines did really well. So that's also the reason why the stock has seen a sharp fall. If you look at the numbers, revenues for the company have grown by 17%. There's an EBITDA growth as well of 8% on a YY basis at 81.4 crores. But margins have seen a decline. Margins declined 200 basis points to 19.9% for the company, leading to a profit decline of 3.1%. Now, if we compare it with Balaji Amines, that company saw a margin expansion on a YY basis, and that is the reason why there is so much disappointment for Alkyl Amines. Additionally, Alkyl Amines is trading at a premium valuations to Balaji Amines, and for last 6 quarters has not been performing as well, or maybe underperforming versus Balaji Amines. And that's why this big disappointment that has come in for Alkyl Amines, and that stock is seeing cuts of around 4%. Weaker numbers and more premium valuations. 2 reasons why this stock is down 4.5% as we speak. That is about Alkyl Amines, but Escorts Kubota, it is also losing in trade on the back of weak quarter and cautious brokerage commentary. Sonia is joining us to tell us more. Sonia?
Well, thanks a lot for that. We do know that the numbers were weak. The numbers came in on Friday itself. But just to quickly run you through the main reason for the disappointment, it's the big margin fall where the margins were down 540 basis points year on year. Now, brokerages have been very cautious on the stock ever since the numbers came through. CLSA maintains a sell. They have cut their target price to 1561 from 1612 earlier. They say that JP Morgan says that a continued market share loss is a bit worrying for the street. In the first half of the year, the market share has fallen about 40 basis points. The management, though, says that it will take at least 4 to 5 quarters for margins to get back to normal. It's because it's not easy to pass on the higher inflation to the consumers because the rural end of the market is still under pressure and there's a lot of competition. They said although it will take 4 to 5 quarters for the margins to get back to normal, they feel that this is the bottom as far as the margins are concerned. The market share has also gone up marginally in this quarter. Market share is up about 70 basis points and gone up to beyond 11%. However, they also ended the conversation by saying that the tractor industry will not touch double-digit growth this year. At best, it would be perhaps mid to high single-digit growth. So slightly cautious commentary from the management, and hence the stock continues to be under pressure. Back to you.
Okay, thank you very much for that. Tattva Chintan Pharma is under pressure as the earnings disappoint. Sonal?
Yes, big disappointment coming in for this particular company. Revenues declined 27%. Margins also under pressure, down 400 basis points. EBITDA down 69%. And margins have more than halved to 12.9%, leading to a profit decline of 78% for the company this time around. Segmental performance, well, the SDA segment hasn't done well. It is a high contributor and high margin product. That has fallen by 87%. But the other two did well. So PTC up 54%, PASC that was also up around 63%. Company has spoken about the SDA contributor because this is a big margin product for the company. They expect recovery in SDA sales in Q4 of FY23, and FY23 sales should be more than 400 crore rupees this time around. ICICI Securities on the back of this have cut their FY23 EPS estimates by 37% because of the weakness in SDA. But because the company is talking about some recovery in Q4, they've increased the FY24 estimates by 4.5%. But the stock is not cheap at all. It trades at 40 times FY23 EPS. It has fallen from the peak valuations of 60 times, but still not promising growth, and that's why that big disappointment. It is the third consecutive quarter of weakness for the company and definitely not taken well by the investors, Rima.
All right, and the other stock that we have on our radar is Interglobe Aviation. It's a mixed bag of earnings. Revenue growth was strong at 121%, but margins were under pressure. Here's a word from their CEO on the performance and the expansion plans.
We see where we are today. We made a loss if we exclude it from foreign exchange, and if we were to exclude from the enormous increase in the fuel prices, we would have definitely in a much better spot. And if you see where we are today with travel numbers basically hitting 7% higher than the situation prior to COVID, with load factors in a quarter which is seasonally weak, around the 80%, and with a yield which is normally in this quarter going down by 10% as compared to the previous quarter, it's now running at just a 3% lower level. So if you take all these elements together, we see a very solid market development. But obviously the price of fuel and these rate of exchange, as we just alluded on, had a negative effect. Take a little look forward. We continue our capacity expansion and our network expansion in the third and the fourth quarter going forward. Actually, in the second quarter, we have inaugurated our 100th destination. We continue to expand that network, and we expect to end this year in some 13 to 70% capacity levels higher than the pre-COVID situation. Clearly, demand, as we have seen, remains to be very strong, and that's also why we're taking a lot of measures in order to meet with this increasing demand. Clearly, our priority so far has been restoring the network.
Okay, all right. That's the commentary coming in from Interglobe Aviation, saying that they are increasing capacity because of higher demand. Rightly so, because the travel has increased so much, right? But with that, we'll take your leave on this edition of Mid Cap Radar. Stay tuned. Your stocks when we return.